Thank you, everybody, and thank you, Ranjan, for the biggest and best welcome I've ever had. So I better start it with some good news, hadn't I? Otherwise, you're going to cheer me off again. Do you want good news or do you want bad news? Good news. Inflation! Milk and eggs are cheaper! That's good news, isn't it? Oh, come on, I had to find a good news in there somewhere, didn't I? So inflation's running at 6.7%. It's ended a run of 3 consecutive monthly falls. But it's the first time in 2 years food prices has actually dropped. Now that's the important thing, it's a trend line. But expect food to bounce back because oil prices have gone up because there's this thing called a debate in the Middle East going on. I shall leave it at a debate. But let's put it like this. The other good news is, if you're just over broke, then you've had a pay rise worth 7.8% this year. Now, that is good news for those in a job. It's bad news if you're the Chancellor of the Exchequer, because it now means when wages are above inflation, he's got to step the foot on the gas of the interest rates. Well, it happens. I mean, wage increases are going to put pressure on it. I personally believe there will be another 0.25% rise on the 2nd of November. Now, you better get back here for the November one to either cheer me or jeer me and tell me I was right, that it is going up 0.25%. Wage increases, that's one of the factors. The war in the Middle East is another factor. China, who's following China? Has anybody noticed that unemployment has gone off the radar? It doesn't exist in China. They've stopped reporting it. Hang on, why would you stop reporting data when it was going negative if it's turning around and getting more? No, it's not. The USA, it's got its own problems as well. And we've got this thing called the dead cat bounce, where it looks like the property market was going down. It might have bounced up. But it's a dead cat bounce because it's going back down again. Now, interestingly, let's look and see what the banks think is happening to the interest rates. If we look at the end column over here, I'm not sure how well the laser's coming up, the very far column is sharing what it was a year ago. 1 year money lent between banks, 4.4%. The today column is showing 5.274. Now, if we looked at this last month, the 1 year money and the 2 year money are just slightly cheaper. But when we look 3, 5, 10, 15, 30 year money, the banks are predicting interest rates are going to go up based on where they were last month. So that is telling me long term, the trend is upward. When you read the American data, the Americans are predicting an interest rate rise. What do we do when the Americans do it? They sneeze, we sneeze too. Mortgage rates. Good news, because I like the good news side of things today. The average rate of a 5-year fix has fallen below 6%. Now that's the average of the basket of products that are on the market. So that's a trend line that's indicating 5-year fixes are now coming back under control. Now, 3/4 of mortgage customers are sitting on fixed rate deals. And 800,000 of those deals are going to end in the next quarter, this current quarter. So that's 800,000 people who were on cheap mortgages, averaging 2.25%, coming off onto something that is nearly 3 times as much. That is going to take some cash out of the economy. It's going to cause some stressed borrowers. And to compound that, we've got 1.6 million coming off cheap fixes with rates between 2.25 and 3% next year. So that is going to cause more people more financial stress. Commercial property, if we looked at it in that arena, that's my favourite bag. It's Ranjan's favourite bag. The loan defaults are increasing. Again, a lot of the loans there are hedged. In other words, fixed rate for a fixed term. And the debt outstanding is holding steady at 178 billion. But what's not holding steady is the asset prices, because 2/3 of those £178 billion worth of loans need refinancing in the next 3 years. Now, if commercial property has plummeted like a stone down a hill, do you think they'll be able to borrow as much? Not thinking so. Again, interest rates, they're rising. That's causing a secondary problem for commercial loan borrowers right now because it's putting them out of covenant, their loan-to-value ratios. The major banks and insurance companies, they've started, we've seen it in the early results this year, to make provisions for bad debts. But what we can do is look at bridging and development lenders. They are seeing some serious bad debts appearing. And we can look at that, and I'm sure you can ask your questions to Andrew Binstock next month about what's happening, because a lot of the auction lots are by order of the receiver. Now, if they're by order of the receiver, that's telling us there's financial stress out there, there's repossessions. So the trend has been to shift the riskier lending at the main high street banks since 2008 into development funders.
Are you struggling to find your next commercial to residential conversion project? Well, over the next 2 years, virtually every UK bank branch will close. Banks are fabulous buildings in prime locations, and thanks to permitted development rights, they're really easy to convert to alternative uses under a light touch planning regime. My team have put together a list of over 500 UK bank branches which are poised for imminent closure. And for a limited period only, you can download this list absolutely free. Your next commercial property project is on this list, so download it now and enjoy the rest of the video.
New homes. I mentioned back in February of this year that the major house builders were stopping building. They were laying off their builders. Now, what's interesting is their sales are now starting to follow. 9,221 homes are to be built in the next 3 months. Now, that is down on the same 3-month period last year by 4,093 homes. Now, that to me is telling me the builders are going, we predicted a market slowdown and we got it right. Well, I'll share with you some more evidence about market slowdowns and where the opportunities will come. Now, what's interesting is they lost a third of their sales. Now, their share price was 2.4 billion. They lost 800 million off their share price. Roughly a third was wiped off the value of their shares because their sales are down. And part of it is the Help to Buy scheme, which closed October 22, accounted for 12% of their sales. So it's not a third, but it's a third of the third. Good news is, at the weekend, Jeremy Hunt announces the Help to Buy scheme is coming back in December, and it's going to be boosting new home builds. Now, let's have a think. If it takes a new home builder to get out the ground and build that house 9 months or so, and we do commercial conversions in 3 to 4 months, do you think you can get the first mover advantage? Good opportunity there. I said I'll show you a trend as well on construction. Number of construction apprenticeships. 12,500 in 2018, 7,000 last year. 17,500 people applied to become an electrician via an apprenticeship, but only 2,500 passed the course. So it's basically leaving us with massive skills gaps here. And as well as that, it's a bit like we hear about teachers and doctors leaving the NHS and schools. We've got electricians leaving the industry, so we've got a shortage compounded. House prices, typical price of homes fell by 4.7%. It's the biggest and fastest decrease in house prices we've seen since 2009. High mortgage costs are being blamed for it fueling the 6th consecutive month of falls. The good news, though, is for us landlords, the houses are getting cheaper, the rents are going up, So our margins and yields are growing. So with the average rent outside of London being £1,278, it's up 10% on a year ago. And London is 2,627, which is up 12.1% on a year ago. And rental inquiries are also strong, with over 25 people per property making an inquiry. The bad news is, this graph shows landlords' profitability. The pink bit is the profit. Now, as we can see in two places, 2007, we hit a loss, and we've also hit a loss in the last quarter as well, because the interest rates have gone up. The dark green at the bottom is basically telling us our repairs and maintenance. The middle green is the interest rates. And as you can see, it's gone from flatline, rising quite rapidly. And that's going to push quite a few landlords into stress. Now, what's interesting here, this is taken from the estate agents. It's the average listing price versus the average sale price. What we can see is this gap still continuing to widen. So agents are listing prices on the market at one level, but they're selling at a much lower level. And the sale price fall is 24%. Now here we can see the fall-throughs, the sales that are failing, which again creates opportunities for us to step into. And given that the long-term average fall-through rate is 24% and we're at 26%, we're slightly up on trend. Another pretty graph to bamboozle you with on residential sales, but the dark pink line is this year. The other colours are the last 6 years worth of data. Now, we are performing worse than we have done in any of the last 6 years, week for week, month for month, across that period of time, to the point where our house sales are 10% less than they have been in any of those years. So if house sales are down 10%, but the number of properties being sold is up, does that therefore paint you the picture that there's 35,000 listings a week by sellers, but there's only 16,000 sales? There's more stock on the market, and this is accelerating the downward prices. Commercial auctions, we've got lots offered in the commercial market space in September, 541, but they only sold 378, 60% sold. Now, what I actually find interesting, and I was talking to a good friend of mine who's in the auction space, is it looks pretty good, 60%. But actually, if you strip out the data behind this, what we actually find is only 36% are selling in the room. The rest of them are sold post-auction. Now, this year I've been involved in 4 purchases post-auction, and we've got rude prices accepted post-auction. What's also not being told by that data is of that 36% that sell in the room, around 5% of the buyers pull out. They sacrifice their deposit and pull out. So that is another failure in the process. Residential auctions, again, we're seeing a similar trend, 71% sold. Who here has ever seen an auctioneer champion and we've sold 71%? It's always high 80s, in the 90s. They're proud of their sales. This is an indication of the marketplace. Now, what this does is creates opportunities for us. We've got unsold auction lots. We've got broken chains happening as we speak. We've got negative equity in the marketplace. Now, the next talk that we've got coming is from my good friend and colleague, Ranjan, and it's all about the massive opportunities in permitted development rights. But we've also got, coupled with those opportunities, a growing inventory. I've just demonstrated how organisations like Morgan and M&G are selling off £578 million worth of commercial property because it no longer makes sense for them to hold. And the fund holders are going, we don't want to be in commercial anymore. We want to get out of offices and shops. Well, the government is just opening the door for us to pick the ball up and kick it in the back of the net, as they say. So I want you all to go out, be inspired. There is market opportunities out there in the auctions, in the agents, and in the commercial space that you can grab hold of right now. And before I tell you about permitted developments on steroids that Ranjan is going to share with us, I noticed quite a few people, when Ranjan put the slide up earlier, taking a picture and booking the tickets. Now, we only had, was it 8 tickets or 4 tickets left? 4 tickets left? Yeah. So if you've not grabbed your tickets, I'd grab them quick, because it is selling out fast. It is the property event of the year. There is somewhere near 700 people in the room. It is a great event. I know, Bernadette, you were there last year. Do you enjoy it? It was brilliant. I couldn't have put those words in her mouth. That was brilliant. So all I can say is, if you're not going, you're going to miss out, and you will have FOMO when you watch this on social media, because it is one of the best. And I can tell you, the entertainment last year was stonking. This year blows it out the park, and I'm not joking. So,
the Baker Street Property Meet is the UK's largest and #1 property investors networking event. The property market is going through monumental change right now, and at Baker Street Property Meet we aim to keep you up to date with the latest tips and tricks and insider tactics to help you keep on top of your property investing game and succeed in these troubled economic times. The Baker Street Property Meet is fundamentally about networking, because it's not what you know, it's who you know. And at Baker Street we aim to connect you with the people to make your property journey a monumental success. There's no better place to be to further your property investment journey than the Baker Street Property Meet. So make sure you're here, you're connecting with myself and Andrew Roberts, our expert guest speakers, and 300 passionate property people each and every month. See you at the next meet. Get your spot at bakerstreetpropertymeet.com.